The fastest way to pay off your home, in the essence of what we're talking about, because, as we were just joking, just pay cash. That's the fastest way to pay off your house, is just stroke a check for it, assuming you have that, which most people don't have. So how can you be strategic, and what is the fastest way to pay off your home? Is you have to convert amortized debt into simple interest lines of credit. Then you also have to pair that with a cash flow strategy. The modern day mortgage came about to create more checking and savings accounts. Yes, now they make a lot more in interest income, but the primary goal was to create more people depositing money in checking and savings account, making it a closed-end product, not something that you can utilize as an operating account like a checking account, or like you can in a simple interest line of credit. Money can move in and out freely. So you first and foremost have to take as much, if not all, of that amortized debt and refinance it or purchase it to begin with into a simple interest line of credit. And because a simple interest line of credit not only computes interest differently than a mortgage does, and I'll explain that real quick. When you put money into a mortgage, the dollars go to interest first, then the principal reduction is calculated. In a simple interest line of credit, when you put money into that line of credit, when I say put in, make a payment to it, that's how the banks view it. We call it deposits because we use it like a checking account. When you put money in, dollars first go to principal, then the interest is calculated. So one, you got the interest calculation is massively different from a line of credit versus a mortgage. But two, we have to now combine that with a cash flow strategy. So instead of parking money in a checking account earning 0.07%, let's now park it in the line of credit, because in the line of credit, you're still going to get debit card, credit card capabilities with that line of credit. You're going to get check writing capabilities. You're going to get online bill pay capabilities. So you can move it to cash, make transactions. You can operate in it just like you do inside of a bank account. So we're bypassing the whole bank system altogether, to a certain, because the HELOC comes from the bank, so you're still utilizing them. But now your money, your line of credit is being stored, your money is being stored in this line of credit. It's a vessel to store cash, but you still have utilization there. So you can use it 24/7, however you see fit, but those dollars are going to work for you, keeping the balance low, thus suppressing the interest. Then you have another month, another round of income that's hitting it, suppressing the balance, suppressing the interest. That's the fastest way. So there's multiple ways to do it. There's first lien position home equity line of credit, which means your HELOC pays off your entire mortgage. And no, you don't have to have, if you've got a $300,000 mortgage, you don't have to have $300,000 of equity to pay off that $300,000 mortgage. All you need is 10 to 20% of equity, because it's a refinance. That's where most people get confused. They think they have to have all this equity as a secondary transaction to then move the money over to the mortgage to pay it off. No, you're just refinancing the existing mortgage completely into a line of credit. So that's first lien position. Doesn't make sense for everybody, depending on what their current interest rates are. Somebody's got a 2.5–3% mortgage and they're not massively cash flow positive. Doesn't make sense to do a first lien position home equity line of credit for them. But then there's second lien position, which means, okay, you keep your low rate mortgage, but then you get a HELOC behind it, let's say for 10, 15 grand, whatever, or more. Then you're taking the line of credit, you're maxing it out, dumping that money onto the mortgage, reducing the mortgage balance. And now so you didn't increase the balance of what you owed. You just substituted. This balance went down over here, and then now it's over here. But now this becomes the place to park your paychecks. And so what happens over here is this starts quickly going down because it's more efficient, the way it computes interest, and it's a vessel to store cash and operate out of. And then as it gets to zero, guess what you do? You just use it again to chunk onto this. This comes down. And along the way, you could do what's called recasting, where you call the mortgage company up and say, hey, I used to owe $300,000, now I owe $150,000, and I want to recast that back out to 30 years, because what will it do? It will not refinance, recast. It will reduce your payments, which does what? Your mortgage payments, which increases your cash flow positivity, which means when you're using the chunking strategy, it accelerates getting paid off faster, which means you can chunk at a faster pace and pay the loan off at a faster pace. So those are the two ways.